Top three things in my notebook this morning. Going to go a little global on you. Going to go with Australia, number one, Russia, number two, and go right back to the U.S. wood, which is the bond market, the 10-year bond yield, number three. So first on Australia, again, the eastern side of the world is starting to look better and better as the U.S. dollar burns. We do like currencies that continue to appreciate, and one of those currencies is obviously Australia's. Australia is starting to outperform on the eastern side of the world. So again, if you're looking at Australia versus Chinese stocks, Hong Kong stocks, Singaporean stocks, Australia looks better. So again, last night was no different, the positive divergence. And again, it was after a good economic data point, a 5.8% unemployment rate. While that's still a lagging indicator, in Australia it's better than the alternative. So again, if you look at Australia for what it is, it's a market that we have on the long side of our asset allocation model. Now, secondly, Russia is not where you want to be from an asset allocation perspective. Where you want to be is selling Russia on this 3-day bounce. So what we get is the 3-day bounce. The insiders get paid. Putin pulls the troops out, allegedly, and there you go. You bang the top end of the risk range, and you short the Russian stock market. So again, very straightforward, very understandable process here. You want to be selling Russia at the high end of the range on our signal, and yes, you're getting that on the Russian trading system today. Finally, the 10-year bond yield. What are you going to do for me now? At this point, you got yesterday was like a 2 basis point bounce, and then it's a 3 basis point bounce, and today it's like a beep. Seriously, this is a big, serious risk that continues to develop. And no, we don't think that the bond market's going to blow up tomorrow. We think that growth stocks are going to continue to blow up tomorrow, and that people will hide under their mattress and or put money into treasuries. So again, same concept, and again, that's why we have such a big asset allocation to treasuries specifically right now, because we do think that inflation, while being ignored by Janet Yellen, is going to slow growth on an ongoing basis, and bonds go up when U.S. growth slows on the margin, on the margin, on the margin. Don't forget, on the margin. Top three things.